my guest in the last hour made it very clear. It's about the current account deficits, which will be perhaps most vulnerable. If the yuan breaks 7, it is those pan-Asian currencies that are going to be most exposed. The dollar will rally, and it's those with deficits that will be most exposed. Can I ask you about the bond market? Let's have a look at it. We've got the emerging market chart. This is the Bloomberg chart on emerging markets, and we've seen a rip-roaring rally. It is coming. It's a bit like waiting for Godot. There you go. Love the EM camp. 3 weeks of a rally. Yields are the lowest since July 2008. Is that too far, too fast for you, or how discerning do I need to be?
Now we're in a fiscal repression situation. Let's not forget that there is currently more than $11 trillion of bonds worldwide which do have negative yields. So indeed, investors are looking for yield, and emerging markets currency bonds is probably a very attractive segment to consider. So we are bullish on emerging market debts, more the hard currency one. Okay. But it's true that some high-yielding emerging market currency look interesting. Things about Mexico, for instance. Look at Russian ruble, which has been doing decently well since the start of the year. So there are opportunities on the EM local currency bond side as well.
Charles-Henry, are there any EM currencies that you're choosing to short as a hedge against trade war risk?
Well, EM Asia is most likely to suffer from escalating trade war. You also need to consider countries which are facing twin deficits. Think about Turkey, for instance. So again, there's a lot of things happening within emerging markets. I think the key point here is that if you compare to last year, there was the breadth of, let's say, weakness in emerging markets was very was big. This year we are seeing a lot of dichotomy, and that's a rather positive sign for emerging market currencies.